Hello class, welcome to Understanding Macroeconomics Lesson 4. Now you might remember that these lessons are about measuring economic performance, and these are the ones that I plan to do. So in Lesson 4 we're in Gross Domestic Product. While I was looking for some slides that I had prepared for this lecture, I came across this cartoon. Look at this, this is hysterical. Darrell suspected someone had once again slipped him a spoon with the concave side reversed. See here, he's holding his spoon upside down. The guy's so stupid. He's probably an economist, so technically competent but completely unaware of what's going on. I think it's great. Alright, so back to work. So gross domestic product. It's a measure of economic activity, and here is its formal definition. It is the dollar value of all final goods and services produced in the economy in 1 year. So GDP is just a measure. It's a dollar-denominated measure of economic activity. But there's some words in this definition that are kind of important. Obviously, dollar value is denominated, it's measured in dollars. And so if you're doing a GDP study across several years, you must adjust it for inflation. Remember from the inflation lecture, any analysis done through time that doesn't take into account inflation is just wrong. So if you see a chart of GDP, dancing through time, if it's not adjusted for inflation, it's wrong. The other term that's important is this one here, final goods and services. And I have a separate slide about why this is important, but basically there are lots of transactions that are occurring between businesses, B2B transactions, and those are not counted in GDP because ultimately they get whatever those are, they get counted again when the final product is sold to the consumer. And then this word produce, that sounds so simple, but keep in mind that gross domestic product only tracks production. So for example, if you bought some stock low and then lucky you sold it high and you made a big profit, maybe even $1 million profit, that wouldn't be counted in GDP because it doesn't represent production. And finally, GDP is calculated for each economy. So there's a GDP number for the US economy and a separate one for Canada and Mexico and so forth. That's important because it impacts imports and exports, which we will get to in a minute. Okay. This is the first attempt to try to conceptualize economic activity on the macro level. This was published by this French economist Quincey, the Tableau Économique. And I teach a class called the History of Economic Thought, and this comes up. And I've looked at this thing for a long time, and I'm embarrassed to tell you that I cannot make heads or tails of what Professor Quincey was trying to say here. Another one is this one from Frank Knight. This is in the early 20th century. He called this thing the Wheel of Wealth, and this is much more like what we use today. And I have a simple version of this thing coming up in a minute. But before that, I have a couple of others that I've collected over the years. This one comes from a very popular textbook by Gortney and Stroop. Look at this crazy thing. It's almost disgusting. Right? And it would take me a long time to figure out what's going on here. And I don't think all that stuff is necessary. But that's not the worst one. Look at this one from Dushkin Publishing, which I don't think is even a company anymore. Whoever drew out this thing obviously had a problem with economic activity. I cannot figure this thing out, although it's really quite beautiful. Anyway, so those are a couple of the more awful ones that I've seen. Oh yeah, and I forgot about this cartoon. This guy, oh God, another expert saving the economy. So here's GDP and this nonsensical flow here. But keep in mind, this nonsensical flow doesn't look all that different really from these, at least to me. So what we need is a simple abstraction that, conceptualization of what economic activity looks like. And the way we do it is with this. So this is a very simple one. Think of it like this. All economic activity can be expressed as the interactions between two agents, households and businesses. all economic activity can be expressed as an interaction between these two groups, households and businesses. All right? So now think about the definition. The dollar value of all final goods and services produced in the economy in 1 year. So let this little gauge here represent GDP. If you took that gauge and you placed it into this circular flow here, on this pipeline right here, it would measure GDP. Here's why. Think about what this represents. Businesses are producing goods and services, see, and they flow to households. Businesses produce goods and services, they flow to households, and then households pay for those goods and services with money. So this flow of money that's coming from households back to businesses in the form of sales is one way to measure GDP, and that comes from our definition. But there is another definition of GDP that's less popular, but just as good, and that is that GDP is the total sum of all incomes produced in the economy in 1 year. So you could take another gauge, and if you place that gauge over here on this money flow, this represents business payments back to households for their resources. So it could be income, like in the form of wages for laborers. It could be rent in the form of the businesses renting assets from a household. It could be interest if it's financial assets. It could be profit. Doesn't matter. But this flow right here represents business payments to households in exchange for the inputs that they need to produce stuff. And so that's this definition right here. So I hope you can see that no matter where you put that gauge, it would measure GDP. Okay, so that's a good way to think about what GDP is. Now, so what does it mean, final goods? So I created a separate slide to make sure you understand what final goods is all about. So imagine that the Magical Mystery Machine Van Company bought 4 new American-made tires to mount on one of its new vans. So this company buys these tires, and then let's assume the tires were $250 each, and the van later sold for $50,000. So the tires are on the van now. So now the question is, what is counted in GDP? Should we count the 4 tires? That would be 4 times 250, that's 1,000, plus the 50,000 for the van. So is this 51,000 towards GDP, or is it just the 50,000? I hope you can see that the correct answer would be just the 50,000, because if you counted these tires when the company bought them and then counted again the van when it was sold, it is obvious that the cost of the tires is embedded in the cost of the van. And that would be true of everything. It would be true of the battery, the upholstery, the gasoline if there was any in it, the paint, whatever is in there. When the firm buys them, they're intermediate goods, and ultimately the firm gets their money back when they sell the final product. So that's why it is that only final goods are counted, because if we counted intermediate goods, things would get counted twice. Okay, so what does GDP measure? Well, it doesn't measure happiness. Oftentimes people will think GDP and happiness are the same thing. They are not. It just measures economic activity. And I'm going to give you a couple of examples of how it's not true. It's easy to assume that all economic activity is good, but no, it's really not. So consider this. What about pollution? Let's say that there's a factory on the edge of town. Hey, I'm here in Charleston, and we have a paper mill on the edge of town, and it makes a very fine product that's sold all through the economy. But in the process of making that product, it dirties the air, right? So if we just measure GDP as the economic activity that's coming from all of those factories, we don't have any way to account or to subtract out the damage to the environment that's done. And then later, let's imagine that somehow the firm puts pollution abatement equipment in its process. Well, that pollution abatement equipment probably costs millions of dollars, which would raise the price of the product, and so that would show GDP going up. So, on the one case, we don't have a way to subtract out the cost of pollution and then We have pollution abatement equipment, which is reflected in GDP. So that's a problem. GDP does not measure happiness. Now there's one more. Consider natural disasters. Heaven forbid, but let's imagine that a big hurricane hits in Charleston and maybe a third of all the roofs in Charleston are damaged and have to be rebuilt. Well, that would be a tremendous expense to all the people who had those damaged roofs. But as they paid for that, since they're the ultimate consumer, it would raise GDP by millions and millions of dollars. But keep in mind that that's not happiness. That extra GDP is just to replace something that was destroyed. So some people mistakenly say, oh, natural disaster has a silver lining because it stimulates the economy. No, that's completely false. So that natural disaster destroyed a bunch of stuff, and this thing that's measured in GDP is just the activity to replace something that was destroyed. All right, so let's go over a few rules about what is counted and not counted. Some of these are obvious, but some are not. So let's start over here. Let's get the definition of GDP, the dollar value of all final goods and services produced in the economy in 1 year. Now, new goods obviously are counted, but what about used goods? Used goods are not counted because they don't represent production in this year. So if you bought a car that was 5 years old, it was maybe counted in GDP 5 years ago, but if you buy it today used, it's not counted. Now the only caveat to that is, let's say you bought that used car from some used car dealer. So you go to Honest John's used car lot and you buy it. Now in this case, let's just make it simple. Let's imagine that Honest John bought the car from somebody who didn't want it anymore for $10,000. And then Honest John cleaned it up, put a little warranty on it, and sells it to you for $12,000. So that difference, that $2,000 between what Honest John bought it for and what he sold it for, would be counted in GDP because it represents the service provided by Honest John. But the actual cost of the car, the $10,000, is not counted because it was counted years ago when it was new. All right, so new goods are counted, used goods are not, except if there's any service provided in the transaction of the good. All right? Exports are counted, but imports are not. So remember, it comes because GDP is about what's produced in our economy. So exports are produced in our economy even though we don't get to consume them, right? And imports, which we do get to consume, that's a good thing, but they're not counted in our GDP because they weren't produced here. A lot of people have this kind of backwards, and they think exports are the good thing and imports are the bad thing. But really, in terms of consumption, exports are the cost that we incur in order to get the things that we want from abroad, the imports. All right, so exports are counted, imports are not. Then illegal goods are not counted. It doesn't show in the definition, and in fact, this is a bit controversial between economists. There are some economists that think this is right, we shouldn't count illegal goods, but others, and I'm probably in the second group, think that maybe we should. Now, I'm not talking about really terrible illegal things like illegal drugs, loan sharking, and stuff like that, but I'm talking about things that are down in the gray market. So somebody over their summer vacation is mowing grass or painting houses or doing repairs or something, and they're kind of under the radar of the government. Those things are technically illegal. We usually call them gray market goods, but they are not counted. It's hard to know how big the gray market is, but the best figure I can report to you comes from a sitting president a few years ago, and they had a task force, and they said they thought the gray market was about 20, maybe as much as 30% of the U.S. economy. And of course, in other economies, like probably in Venezuela, I bet it's 90%. Anyway, no matter what, it's not counted. We don't count things in the gray market. Financial transactions, real estate transactions, are not counted because they don't represent production. This is a good stumbling block for students. So if you bought a piece of real estate say for $5,000 and you held it a few years and then you sold it for $50,000, good for you. But it's not counted in GDP because it doesn't represent production. Now, if you were paying attention up here, you might notice that, okay, if you sell that piece of real estate and it requires you to hire a lawyer to close the deal and to file the papers, then whatever the lawyer charges you is counted in GDP because it represents a service provided in this year. But the actual cost of the land or the real estate or the art collection or whatever it is that is not counted because it doesn't represent production. All right. So what about raw materials? Well, we did this one before. Raw materials, intermediate goods are not counted because they are ultimately counted when the final product is sold to a consumer. Yeah, so we only count final goods. This is the slide I did earlier. Okay, so now there is one special case about owner-occupied housing. It doesn't even show up in most textbooks, and I can't even remember why I know about this special case, but because I know about it, I'm going to share it with you. So imagine that you got a really big inheritance, maybe $500,000 from a long-lost family, old uncle or cousin or something who gave the money to you. Good. It's fantastic for you. So you have $50,000 and you decide to spend the money in a very smart way. So you take half of it, that's $250,000, and you buy a small house, a little starter house, and you live in it. You paid cash for it. You live in it. We would call that owner occupied. You don't have a mortgage. You don't have anything. You're not paying any rent, okay? But then you took the other half, the other $250,000 out of your $50,000 inheritance, and you bought another house down the street from yours, very similar, and that one you rent out, and maybe you rent it for $2,000 a month. Okay, so now the question is, what is counted in GDP? Well, this is obvious. This would be counted because this represents a service, the dollar value of all final goods and services, right? So this is counted, but the truth is, and it's kind of counterintuitive, both are counted in GDP. This is just a decision that was made years ago, and so there is somebody at the Bureau of Economic Analysis that compiles the GDP data who estimates the rental value of every house, whether it's actually rented or whether it's owner occupied, and that rental value is added to GDP. It's really quite unusual, but that's what they do. Oftentimes students ask me how that crazy rule came to be, and I don't really know, but I think it might have to do with people's decisions on whether to rent or to own. So, you know, when interest rates go up and down, it causes big differences in people's decisions about whether to buy a house or whether just to rent something. And so probably the early economists who were studying GDP didn't want the GDP numbers to vary on that, so they just pretended like everybody rents, so that decision would be, it would be moot. Okay, so that's a special case. Now, let's summarize what we've done in this lesson. GDP is a measure of economic activity. It's not a measure of happiness. All you have to do is consider natural disasters and pollution to see that. Since GDP is measured in dollars, it suffers from inflation bias. Time series studies of GDP must be adjusted for inflation. If you don't remember anything else from this lesson, you should remember that. So when you're in some presentation someday and someone's talking about GDP, look carefully to see if they've adjusted it for inflation, because if they have not, their analysis is incorrect. Okay, so that's it. I hope this lesson is helpful. See ya.